Most British people think HMRC exists purely to take their money. And honestly, can you blame them? Nobody teaches you any different. You get your first payslip, you see that chunk missing before you even touch it, and you just assume that's the deal. That's life. That's being British. But here's the thing that's going to bother you for the rest of the week once I say it. HMRC is not just collecting money. HMRC is also paying it out. There are entire sections of the UK tax code written specifically to put money back into your pocket when you invest in the right things. Not loopholes, not dodgy offshore schemes, legitimate, documented, government-approved incentives that the Treasury wrote into law specifically to reward you for doing what they want done. I'm going to show you exactly what those things are, how much HMRC will pay you to do them, why the average person in this country will go their entire life without ever touching a single one, and how the wealthy in Britain have been quietly using these exact strategies for decades to build the kind of money that most people assume is only possible if you were born into it. By the end of this, you are going to see the UK tax code completely differently. Not as a punishment, not as a system designed against you, but as a menu that Parliament wrote specifically to reward certain behaviour, and if you just pick the right items off that menu, HMRC will literally subsidise the life they want you to live. Let's get into it. The single most important thing to understand before anything else is this. The UK tax code is not designed to be fair. It is designed to incentivise behaviour. Every relief, every allowance, every credit written into that code was put there by Parliament to steer private money towards something they wanted funded. Housing, energy, business investment, pensions, enterprise, research. If you do what the tax code is asking you to do, the tax code will pay part of your bill. If you ignore it and just sit on a PAYE salary and never ask any questions, you will pay the highest effective rate going. The average PAYE employee in the UK is handing over somewhere between 25 and 45% of their earnings once you factor in income tax, national insurance contributions, and everything else that disappears before the money even hits your account. The average wealthy British person is paying closer to 15%, sometimes less. Not because they have better accountants, though they do, but because they understand that the code is a menu, and they know which part of the menu to order from. Here's what's on that menu. The first thing HMRC will pay you to invest in is a business. The moment you have a legitimate business, your entire financial picture changes. Every laptop, every phone used for work, every subscription, every business meal, every mile driven between client meetings, every penny you spend educating yourself about your industry, all of it becomes a deductible expense against your taxable income. That means you get taxed on profit, not on revenue, and you control how much profit the business actually shows. A PAYE employee earning £60,000 pays income tax and national insurance on the full £60,000. A business owner earning the same £60,000 can legally deduct tens of thousands in legitimate business expenses before HMRC ever sees a taxable figure. And it gets better than that. The annual investment allowance lets businesses write off up to £1 million of qualifying plant and machinery in the same year they buy it. You are not waiting years to claim relief on equipment. You get it immediately. Parliament wants businesses investing in their own growth, so they built the rules to reward that behaviour directly. Then there's the structure. Running through a limited company in the UK means you can pay yourself a small salary, take the rest in dividends, and legally combine income tax, national insurance, and corporation tax in a way that produces a significantly lower effective rate and PAYE. This is not a secret. This is why millions of contractors, consultants, and small business owners operate through limited companies. The system is designed to reward the people who own the machine, not just the people who operate it for someone else. The second thing HMRC will pay you to invest in is property, and I want to spend real time on this one because this is where serious wealth gets quietly built in this country. When you buy a rental property in the UK, several things start working in your favour simultaneously. The mortgage interest element isn't deductible the same way it used to be. Yes, that changed, but there is now a 20% tax credit on finance costs that landlords can claim. More importantly, every allowable expense on the property, repairs, letting agent fees, insurance, maintenance, professional services, all of it comes off your rental income before you get taxed. But the real play in property isn't about the tax on rental income, it's about capital gains tax, and specifically how to legally reduce or defer it. When you sell an investment, there's a way to structure property ownership through a limited company that changes the entire tax picture. Inside a company, property gains get taxed at the corporation tax rate, currently 25% for larger profits and potentially lower if profits are modest. More importantly, profits inside the company can be reinvested into more properties before any personal tax is taken. You are compounding with pre-personal tax money. That is a completely different growth trajectory over time. Then there's holdover relief, gift holdover, rollover relief for business assets, and the ability to restructure property portfolios in ways that defer gains almost indefinitely when done correctly. The point is that the code gives you tools. Most landlords never pick them up. And then there's something that almost nobody talks about. If you own a property in a qualifying area and you operate it as a furnished holiday let, or at least you used to before the April 2025 changes, you got access to full mortgage interest deductibility, capital allowances, and the ability to claim retirement relief on the sale. The FHL rules changed in 2025, so I won't go deep on this one specifically, but it's a perfect example of how the tax code has always created pockets of advantage for certain types of property investment, and how those pockets keep shifting, which is exactly why you need to stay on top of the rules or have someone who does. The overarching point on property is this: every pound of rental income you can legally reduce through allowable expenses, every gain you can structure through the right ownership vehicle, and every disposal you can time correctly against annual exemptions and other losses is a pound that never reaches HMRC. The tools are there, they're just sitting unused because nobody told you they existed. The third thing HMRC will pay you to invest in is one that almost nobody in Britain talks about, and when I explain it, you'll understand why the wealthy keep it so quiet. The Enterprise Investment Scheme, or its younger, more aggressive cousin, the Seed Enterprise Investment Scheme. These are two of the most extraordinary tax incentives ever written into British law, and they are completely legal, completely documented, and almost completely unknown to the average person. Here's how EIS works. You invest in a qualifying UK company. In return, HMRC gives you income tax relief worth 30% of what you invested, right off your tax bill. Not your taxable income, your actual tax bill. Direct, immediate reduction. So if you invest £100,000 into a qualifying EIS company, HMRC writes £30,000 off the tax you owe. You have effectively invested only £70,000 of real money, while having £100,000 working for you. But that's just the beginning. If you hold the shares for at least 3 years, any profit you make when you sell is completely exempt from capital gains tax. No CGT at all. Zero. If the investment goes wrong and the company fails, you can claim loss relief against either income tax or capital gains tax, which means your downside is cushioned by the tax system too. On a 100% loss scenario with loss relief applied, your actual real-world loss as a higher rate taxpayer can be as low as 38.5 pence in the pound. The government is sharing your risk. And if you have an existing capital gain from somewhere else, selling a property, selling shares, selling a business, you can defer that gain entirely by reinvesting it into an EIS company. The gain disappears from HMRC's view until you eventually sell the EIS shares, and by then you can structure the timing to make the tax consequences as small as possible. SES is even more aggressive for earlier stage companies. 50% income tax relief on up to £100,000 invested per tax year. That is £50,000 straight back from HMRC on the maximum investment. Capital gains exemption on profits and CGT reinvestment relief on top. The government is essentially co-investing alongside you in British startups because it wants that capital deployed into growing British businesses. These schemes exist because Parliament decided it was worth giving up a significant amount of tax revenue in order to get private capital flowing into UK enterprise. They are not exploiting a gap in the code. They are the code working exactly as intended. HMRC publishes the rules, Parliament defends them. And yet the overwhelming majority of British people who would qualify to use them have never heard the letters EIS in their lives. The fourth thing HMRC will pay you to invest in is your pension. And I know you've heard about pensions, but I promise you have not heard this. The pension tax relief system in the United Kingdom is one of the most generous government subsidies available to ordinary people. It is also one of the most deeply underused. Here's how it actually works. Every pound you put into a pension comes from your pre-tax income. If you're a basic rate taxpayer, HMRC adds 20 pence for every 80 pence you contribute, making it a full pound going into your pension. You never paid tax on that pound. If you're a higher rate taxpayer, you claim back an additional 20% through your self-assessment, meaning a pound goes into your pension and it's only cost you 60 pence out of pocket. If you're on the additional rate, it's cost you only 55 pence. That is HMRC paying you 45% of every pound you invest in your own retirement. On a contribution of £40,000, the maximum annual allowance for most people, HMRC is handing you back up to £18,000 in relieved tax every year, for every year of your working life. And the money inside the pension grows entirely free of income tax, capital gains tax, and dividend tax. There is no more sheltered environment for investment growth anywhere in the UK tax system. Now here's where it gets interesting for business owners, and this is where the real money is. If you run your own company, the company can make pension contributions on your behalf directly. These contributions are a business expense, so they reduce the company's corporation tax bill. They also don't count as salary, so there's no national insurance on them from the employer or the employee. You are getting corporation tax relief and national insurance relief at the same time, stacking two different reliefs on top of each other on the same pound. A business owner who maximizes company pension contributions can legally move tens of thousands of pounds per year out of corporation tax and into a tax-free investment environment. Over a career, that is the difference between a pension pot that lets you retire comfortably and one that forces you to keep working. And then there's something most people completely miss: the lifetime ISA. Aimed at under 40s, the government adds a 25% bonus on top of every pound you put in, up to £4,000 per year. That's a free £1,000 a year from HMRC, in cash, sitting in an account invested in whatever you choose. It's not complex, it's not specialist, it's a government website and a direct bank transfer. And millions of people who qualify for it never open one. The ISA system, more broadly, stocks and shares ISAs, cash ISAs, innovative finance ISAs, is a framework the government built specifically so that investment returns can compound completely free of tax forever for every adult in the country. £20,000 per year, per person, growing with zero income tax, zero capital gains tax, zero dividend tax. A couple maximising ISAs over a 30-year working life is building an investment pot of potentially several £1 million that HMRC can never touch a penny of. That's not a scheme, that's not a workaround. Parliament built that intentionally, and they left the door wide open for anyone willing to walk through it. Now let me go beyond the four main categories, because the UK tax code has layers, and the wealthy stack these things on top of each other in ways that most people never see. Venture capital trusts, similar to EIS but through a listed fund structure, 30% income tax relief, tax-free dividends, tax-free gains. You get professional fund managers deploying your money into qualifying companies, while HMRC covers nearly a third of the investment cost. The Research and Development Tax Credit. If your company spends money developing new products, new processes, new software, or improving existing ones, HMRC will give you back a significant chunk of those costs, either as a reduction in your corporation tax bill or, if you're loss-making, as an actual cash payment. Thousands of small businesses qualify and have no idea. The average accountant who hasn't specialised in this area probably won't bring it up. Business Asset Disposal Relief, formerly called Entrepreneurs Relief. When you sell a qualifying business you've owned and worked in for at least 2 years, the first £1 million of gain is taxed at just 10% capital gains tax rather than the standard rate. That's the government specifically incentivising people to build and sell businesses by making the exit significantly cheaper. The Seed Enterprise Investment Scheme again, but at the structural level. The UK government has created a pipeline from SEIS to EIS to VCT designed to keep private capital flowing into British business at every stage. At every step of that pipeline, HMRC is subsidising your investment. Most people don't invest in early-stage businesses because they assume the risk is too high. The reality is that after SEIS relief, the risk profile of a typical early-stage investment looks completely different. You're not taking on the full risk. HMRC is taking a big chunk of it with you. Gift aid. This one isn't about investment returns, but it's worth including because it's free money that gets left on the table constantly. Every £1 you donate to charity through gift aid allows the charity to claim an extra 25p from HMRC. And if you're a higher rate taxpayer, you claim back the difference between the basic rate and your rate through self-assessment. A higher rate taxpayer donating £100 costs them effectively £60 and delivers £125 to the charity. HMRC is subsidising generosity. Most people tick the gift aid box without ever claiming their own personal relief back. Capital gains tax annual exemption. Every UK taxpayer gets an annual tax-free allowance for capital gains. It's smaller than it used to be after recent changes, but it still exists. And the strategy of deliberately realising gains each year up to that threshold to reset your base cost on investments is something sophisticated investors do routinely, and most people never think about. Salary sacrifice, not just for pensions. Electric vehicles through employer salary sacrifice schemes let you drive a brand new car funded from your pre-tax salary, saving income tax and national insurance on the cost of the car. Cycle-to-work schemes, childcare vouchers. All of these reduce your taxable income using money you are already going to spend. The government built them to encourage certain behaviours. Most people don't know they can ask for them. Let me give you a real-world example, because this is the part that changes how you think about money forever. Imagine someone running a small business in the UK. Sole trader or limited company, they're making £150,000 a year. No planning, just paying what they're told. At that income level, they're looking at somewhere between £60,000 and £70,000 going to HMRC through income tax, national insurance, and whatever other liabilities land on their lap. Nearly half their gross income, gone before they can do anything with it. Now let's run the same person through the strategies I just walked you through. They maximise pension contributions through the company. Call it £40,000. That's corporation tax relief on those £40,000 and no national insurance on it either. They invest £50,000 into a qualifying EIS company. HMRC gives back £15,000 in income tax relief immediately. They use the annual investment allowance on £60,000 of equipment for the business. The full amount comes off taxable profit this year. They ensure the family are using ISA allowances in full, $20,000 each for them and their partner. Tax-free growth forever. They make sure every legitimate business expense is being claimed. Not aggressively, not questionably, just correctly. Phones, travel, subscriptions, training, professional services. The things most business owners forget to document properly. Add it all up. The tax bill doesn't drop to zero, that's not the point, but it drops dramatically. The effective rate on £150,000 of income, managed intelligently across these structures, can be closer to 20 to 25% rather than 45%. That is tens of thousands of pounds per year staying in their pocket and being reinvested rather than handed over. Over 10 years, the compounding effect of that difference isn't a little extra spending money, it's life-changing capital. Here's the part that actually matters, and it's what I want you to take away from this. The reason most British people never touch any of these strategies isn't because they don't qualify, it's because nobody ever explained to them that the tax code is a set of instructions for getting paid by the government for certain behaviour. Your school didn't teach you this. Your university didn't teach you this. Your employer definitely didn't teach you this. And your financial advisor, if you have one, was probably trained to sell you products, not strategies. So the code just sits there, full of incentives, full of reliefs, full of government money waiting to be claimed. And the average person goes their entire working life paying the maximum rate because they never knew there was another way. Parliament put every single one of these reliefs into the tax code deliberately. They decided that housing, enterprise, energy, pensions, education and charity were worth subsidising with public money. They decided the best way to do that was to reward private citizens for investing in those things. They basically said, we will take less of your money, or give some of it back, if you just do what we're asking. And then they didn't tell anyone. The people who find out tend to get wealthy. The people who don't tend to spend their entire lives feeling like the system is against them. And the maddening thing is, the system isn't against them at all. The system is just sitting there with the door open, waiting for someone to walk through. So walk through it. Start with one thing. A pension contribution you haven't maximised, an ISA you haven't opened, an EIS investment you haven't explored, a business structure you haven't reviewed. One thing. Get it right. Add another, then another. This is how it compounds. This is how the gap between people who have money and people who are trying to get money gets wider every single year. Not because life is unfair, but because information is distributed unequally, and the people with the information act on it, and the people without it don't. You now have the information. What you do with it is the only question that matters. HMRC is not your enemy. HMRC is an incentive system with an enforcement arm. And the moment you stop fighting the system and start reading the instructions, you stop being the person paying for the game and start being the person the game was designed to reward. The door is open. The reliefs are there. The money is waiting. Go and claim it.